Good afternoon, folks. Ron Ray here, Turning 65 Solutions, tax and insurance, and also homestead family wealth management. Welcome to the webinar today. I'm super excited to have everybody here. Haven't done a webinar in quite some time, but I've been getting a lot of requests for certain information, and this is really an efficient way to get it out there. And from the comfort of your own home and the comfort of my office here, and just get everybody's questions answered and see how we can help you. So glad everybody's here. We've got a couple of quick little items of housekeeping. First of all, there's some controls on your screen, and you should be able to see me down in the corner or at the bottom, and then the slideshow should now say how annuities fit into your retirement portfolio. This is some new software for me, so I want to make sure everybody can see what I'm doing on your end. And if anybody, you also should have some controls. One should be for a chat box. If everybody can see that. If you have questions as we go along, type them into that chat box. Unfortunately, because of the number of people here, I'm not going to be able to really let anybody unmute and ask questions verbally. It just really kind of can cause some problems on these webinars sometimes with noise and feedback and things like that. But feel free to type them in there, and I'll get these questions answered as we go along. And stick around till the end. We've got some special offers for you at the end. So. Most of you know me. My name's Ron Ray. I'm a financial advisor here in the San Antonio, New Braunfels, Texas area, Central Texas Hill Country, and been in this business for quite a while now. So I'm gonna just kind of tell you a little bit about myself. My name's Ron Ray, and this is my second career as a financial advisor. I've been doing this for about 15 years now. But before that, I was a police officer for about 23 years, about 12 years active, and then about almost 12 years in the reserves. Just retired from that, completely retired out of it last a little more than almost 2 years ago altogether. So this is what I do now, is being a financial advisor. And I pretty much work with just people who are getting close to retirement or recently retired or been in retirement for a few years. I really don't work with people in their 20s and 30s and 40s. And so that really kind of allows me to narrow my focus on you and the things that mean the most to you. Now, I'm a licensed health and life insurance agent here in the state of Texas and licensed in multiple other states where I work with agents around the country. And I am a Series 65 securities registration with the SEC and the Texas State Securities Board, which allows me to provide investment advice to folks. And our business here, Turning 65 Solutions and Homestead Family Wealth, mainly deals in the four main areas of retirement as we see them, four pillars of retirement, and that's health, medical insurance, healthcare, probably the most important piece of the puzzle. And that's probably the biggest part of our business is Medicare and health insurance. But also along with that are the other three pieces of the puzzle, which are incredibly important too. Be long-term care. We don't want to pay your life savings out to a nursing home if we don't have to. Also, life insurance, leaving a legacy, being able to pay your final expenses and pass along any wealth that you've accumulated in an appropriate manner. And the final piece of the puzzle, also incredibly important, is retirement income and Social Security planning, making sure that you can enjoy your lifestyle in your retirement years without having to worry about running out of money or outliving your money. And that's part of what we're going to be talking today, is that fourth piece of the puzzle. And we get a lot of questions about annuities. Annuities are really heavily marketed to folks in your age group, and there's some good information out there, and there's some bad information out there. But what I do is I just help people like you who are approaching retirement or been in retirement for a few years get through the rest of your life without running out of money. And annuities are an important tool in our tool chest that we that we use to do that. And I've been doing it so long now that I train, agents and investment advisors all over the country in this. I speak at conferences all over the country. And I've been writing articles and contributing to different media outlets on these topics for many years. Currently sit on the Newsweek Experts Forum in the financial discipline and write articles for Newsweek currently. But enough about me. This is what we're going to do today. I'm going to answer 3 big questions for you. And whenever I'm looking at something for myself, purchasing something, or somebody's telling me about this new thing that they've got, the main 3 questions that I have, and 3 questions that you should have as well, are: what is it? How does it work? And why do I need it? And so those are the 3 questions. If we can answer all 3 of those questions favorably, then, maybe we can do business. And if we can't, then, I'm probably not going to be interested in whatever you're selling. So hopefully I'm going to be able to answer those 3 questions for you. And then you can make a good, educated decision on if you're going to be buying what I'm selling. So here we go. And don't forget, if you have any questions, just type them into that chat box, and then I'll answer them as we go along, or some of them I may save till the end and have a little Q&A session at the end. Okay. So we're talking about annuities today, and what annuities are and how they fit into your retirement plan. And we do have one quick question that I can answer right now: does life and legacy include prepaid final arrangements? And it may certainly include that. I don't really care what tool you use for that part of the plan, as long as you have a plan. And so I don't sell prepaid funeral arrangements, but I do have relationships with a couple of funeral homes that I trust to do a good job with that, so we can point you in the right direction. I'm in the camp that says that it's possible to have too much life insurance, and so we don't want to sell life insurance just to sell life insurance. We just want to make sure that you have a plan for that portion of the puzzle. Okay. All right. So we need to define, first of all, what is an annuity? And so I pulled a couple of definitions just right out of Webster's: a sum of money payable yearly or at other regular intervals. And then another one this is a good source to kind of get some answers, Investopedia on the internet: a financial product that pays out a fixed stream of payments to an individual. Annuities are created and sold by financial institutions which accept and invest funds from individuals, and then, upon annuitization, issue a stream of payments at a later point in time. So that's a little bit closer to what we do. But some examples of pensions, of annuities that you may not have thought of before would be a pension. A pension is, by these definitions, an annuity. So you, while you're working, and or your employer, while you're working, are setting money aside in an account, and they're investing that money or saving it for you. And then at some point in time, when you do your time with that company, and maybe even the government, you've worked your 20 years, you've spent your time required to earn your pension, and at some point you're going to start collecting your pension benefits. Well, when you do the paperwork, they'll have several options for you. It'll be a lifetime annuity, or a joint annuity where it lasts the rest of your life and your spouse's life, maybe at a reduced rate for your surviving spouse. Maybe they only get 50% or 75%, or maybe they get 100% of it. Well, guess what? That pension is an annuity. That pension payment, after it started to pay out, that's an annuity by definition. What about Social Security? Social Security works the same way. You pay into it while you're working. Your employer, if you're employed, not self-employed, pays in a portion as well. So you pay in your Social Security taxes. Your employer pays a portion on your behalf to Social Security. And then when you reach the age of retirement, where you decide, okay, at age 62, you can start drawing Social Security, though at a reduced rate, up to your full retirement age, which depends on the year you were born. It may be 64, it may be 67, depending on where you're born in that area. You can turn on that Social Security check. Guess what? That is an annuity. it lasts for the rest of your life. They're going to take that money that you paid in and they're going to convert it into equal payments for the rest of your life. Now, there's some cost of living increases, hopefully, along the way built into that, but you're pretty much going to get what you're going to get for the rest of your life. And then upon your death, it may go away. Now, there's some provisions in there for a surviving spouse, but one of those Social Security checks is going to go away. Usually your surviving spouse is going to keep the higher of the two, but one of them's going away. Okay. Social Security is a annuity upon payout. What about life insurance proceeds? If you have a family member or spouse that dies and there was a life insurance policy in force on their life upon their death, you have different options for collecting that death benefit from the insurance company. Most common is just to take it in a lump sum, in which case that is not an annuity. That's just a lump sum death benefit payout. But you can also take it as an annuity. You can take it as annuity payments, and they may pay you for 10 years or for the rest of your life. There's different options, just like there is with your pension. So your life insurance proceeds, the death benefit from a life insurance policy, can be paid out as an annuity. Here's one that a lot of people don't think of: lottery winnings. You know, if you play the lottery, I don't, but my wife does. And I always tell her, you know, because she wants to win these big jackpots, these big, you know, $100 million, $600 million jackpots, and she would think that it's probably better to take the lump sum and give up half of the jackpot. Well, you know, it's you can do that. You can take it as a lump sum, but it costs you, I guess, I don't even know, roughly half of whatever the jackpot is, or you get the whole jackpot, but they pay you out over the course of 20 years. Well, guess what? That 20-year payout, that is an annuity by definition. So lottery winnings can be an annuity. Now, for our purposes, for what we do, we are talking about an annuity is a contract with an insurance company where you put on deposit with an insurance company a sum of money, usually a lump sum of money, and the insurance company invests that money in the way that they invest it. They make money, they pay you a certain amount of money, interest, and then at some point in time, you're going to convert that money into a stream of income that lasts a certain period of time. Maybe your whole life, it may be 10 years, it may be 20 years, it may be joint with your spouse. There's several different options. However, that is going to be paid out over a certain period of time, making it an annuity. So we have a question. What about the TV ads promoting sell your life insurance policy even if you own a term policy? What's the reality there? Yeah, so what they're doing is there's companies that buy the rights to claim your death benefit on your life insurance. Those are called viatical agreements or life settlements. And a lot of people own life insurance policies, and you may need to get access to that money before you die for, you know, various different reasons. It really doesn't matter. And so there are companies out there that will pay you money up front in return, in exchange for being assigned the death benefit to your life insurance policy. And when you die, the company will get the death benefit. And so they're paying you a factor on the death benefit, just call it 50 cents on the dollar. I don't know what it really is, but you're going to not get the full benefit of that life insurance policy, but you're going to get that cash up front and use it, you know, for whatever you need to use it for. I really caution people about those things. So that's the J.G. Wentworth commercial, right? I have an annuity and I need money now, and I need cash now. So the same thing works with an annuity. Those are usually structured settlements like lottery winnings or lawsuit judgments. Maybe you had a large lawsuit and you got a judgment against a company. It was a personal injury. You know, the Jeff Davis went out and won you $10 million because you got hit by a truck. Well, a lot of times they're not going to give you that $10 million up front. They're going to structure the settlement to pay you that $10 million over the next 25 years. And that's the way your attorney negotiated the deal to get the highest payout. Well, J.G. Wentworth, these companies that do these things will buy that settlement from you for, pennies on the dollar. In the case of the life insurance policy, yes, you have to keep paying the premiums on the life insurance policy to keep it in force so that the company that bought it from you can get the death benefit eventually when you die. So yeah, the payments don't go away. You still have to keep paying for it. And they're not going to pay for it. You're going to pay for it. Okay, so moving on, we kind of defined what an annuity is. How does it fit in with what we do? It fits in with part of an overarching retirement plan. So these are not a silver bullet. They're not a one size fits all, and it's not the only thing that you do or that we do or that you should be doing in your retirement account. Okay, so as far as I'm concerned, and my philosophy of retirement planning and investing, it's one tool in the box. It's one part of a broad retirement plan that serves its purpose, and that's what we're going to talk about. What's the purpose? First, we need to talk about some different types of annuities. There's different types, and annuities, depending on who you talk to, they're kind of a love them or hate them thing. A lot of advisors love annuities, and a lot of advisors hate annuities. So if you watch the commercials from Ken Fisher, financial advisor, does a lot of nationwide marketing on television and radio, and he says, I hate annuities. I would never buy an annuity. Well, it's because he's selling another product to you that doesn't include annuities. And then you might have guys that just only sell annuities. They're insurance licensed only. They don't have a securities license, and that's the only thing they do. Well, those are two extremes, and extremes on either end, in my experience and observation and opinion, are not good. So we need to find a balance between the two and come up with a good plan. But the types of annuities, and I'm going to tell you my opinion of these and where they fit in. Some of them are good, some of them are better, some of them are bad. So first type, and there's hybrids of all of these. I just caution you, there's more than 4 types, but these are the main categories. And the first one is single premium immediate annuity. This is one of the ones that kind of gets a bad rap, and some of it's deserved and some of it isn't. But a single premium immediate annuity, basically what you're doing, just like I said, you're handing over a lump sum of money to an insurance company, and immediately within 30 days, they're converting that lump sum into a stream of income that's going to last a certain period of time. It may be your lifetime. It may be joint lifetime with you and your spouse. It may be life with 10-year period certain. That means the rest of your life or at least 10 years, whichever is longer. So part of the risk with a single premium immediate annuity, a SPIA, is that if you take the life only option and you die before you've gotten at least your initial deposit back, your initial premium back, well, the insurance company just keeps the rest. Your beneficiaries don't get anything. But if we add that 10-year period certain to it and you die within the first 10 years, well, your beneficiary is going to keep getting the payment for the balance of the 10 years. You could do 20-year period certain, life plus 20-year life, and with 20-year period certain. Okay, so there's some there's some guarantees there, but it's still kind of dicey. We don't really know, but the insurance companies know about how long it's going to take for them to pay you that money out based on your life expectancy, and you can bet that they're betting on you dying before you get into their pockets. So the people that set these things up are mathematicians called actuaries. They work on a law of large numbers and the mortality rates in your area. They know with fair certainty about when you're going to die, right? They don't know the day, they don't know the year, but they know a 65-year-old female in San Antonio, Texas, has a life expectancy of 85 years. I don't know what it is, 85 years. And so if you put $100,000 on deposit at age 65, they know that they've got about 20 years before you die, just based on large number averages. And so they're going to dole that money out to you so that it lasts about 21 years, right? So if you've got 20 years to live, but they've made your money, your initial deposit last 21 years, well, you haven't really gotten into their pocket yet. So that's how they make money. That's how the insurance companies make money. Now I'm making an example. It's just to illustrate how they work. Okay. In reality, they're paying interest up front, and then they're calculating the annuity payment based on your life expectancy. You're making money up front on the payments, but at some point, if you live long enough, now you're going to start making even more money off the insurance company. They're going to start losing money. They know what that point is, and they're calculated appropriately. So that's a single premium immediate annuity, and it's irreversible. Once you start it, you can't stop it. There's no flexibility. You can't take lump sum distributions out of it. You get your payment. It's like Social Security. You get your payment, and that's it. You get what you get per the terms of the annuity payment, and that's it. Okay. We don't use that one in my practice for what I do very often. In fact, we really don't use them ever. These have a certain use, doesn't really come into play for what I do as a retirement planner. So the next type is a fixed annuity, which also would include a multi-year guarantee annuity. And by fixed, what I mean is the amount of interest that you earn is fixed. It doesn't change. It can be compared to a CD at your bank. So when you purchase a CD at your bank, you put a certain amount of money on deposit, and they tell you what the interest rate is going to be for the period of time that of the CD. Say it's an 18-month CD or a 2-year CD or a 5-year CD. They're going to tell you ahead of time what the interest rate is, and then you're locked into it. That's what you're getting. Well, fixed annuity works the same way. Now, fixed annuity, so you see this right here, the first part, fixed annuity, they're a little bit more rare. We don't see those very often. They were popular 10, 15, 20 years ago, where there's no end to the annuity except the annuitization date, which is way down the road, 20 years down the road. And the rate that you buy the annuity at, say for example, it's 3%, you're going to get 3% interest every year for the life of that annuity, which for the fixed annuity is open-ended. We don't see those much anymore. They're just not very common. What is very common is what's called a multi-year guarantee annuity, or a MYGA. Now, these are much shorter in duration, and they're closed-ended. So it might be a 3-year MYGA, a 5-year MYGA, 7 or a 10-year MYGA. But you know ahead of time exactly what you're going to get every year for the duration of that annuity. So if it's a 3-year MYGA, you know you're going to get whatever the rate is. Say it's 3%, 3% a year for 3 years. No more, no less. And then at the end of the 3 years, the annuity's over. You can roll it over into a new term at whatever the new rate is at that time, or you can take your money out and go do what you want to with it. If you've got find a better interest rate over here, or a better program over here, or you want to, put it back in the stock market and take your chances there, you're able to do that with no penalties or fees or anything. Okay. Depending on the tax situation of that particular money, there may be tax implications, but there won't be any penalties. Okay, I should probably put that caution in there. There's always tax implications to everything that we do, so we have to talk these things through very carefully before we make any decisions about it. I'm not a CPA or an attorney, So I'm not giving you tax advice or legal advice. You should consult your tax professional and your attorney for tax and legal advice. Okay. So that's a multi-year guarantee annuity. Fixed, you know exactly what you're getting for the term. Okay. Those are pretty popular, especially right now in the interest rate environment that we're in. I'm going to give you some the current rates towards the end of the presentation and tell you what the best deals are out there right now. The next one, and this is probably the most common and most popular, is called a fixed indexed annuity. And I'm going to talk about this in detail in a little bit, because that's the majority of what I do here at Turning 65 Solutions. And so we'll get into that, but that's the next one. So I'm not going to talk about it right now, but the next one, and we do see these quite often. I don't deal in these, and I'll tell you why in a minute, is the variable annuity. Now you say, what's variable in it? Well, if the fixed annuity is a fixed rate of interest, the other thing that's fixed about a fixed annuity is your principal. So you can never lose your principal to the market. All right, it's fixed. So you don't, your money's not invested in the market, so it doesn't go down. Well, it's different with a variable annuity. What's variable about it is your balance. So you put your money into a variable annuity contract. The insurance company then divides it up into one or more of the what's called variable sub-accounts of the annuity, which really are mutual funds. And then your money goes up and down with the market, whatever market those mutual funds are participating in. So you can lose money. You can lose principal to the market in a variable annuity. So variable annuities do have some guarantees built into them. Really, they've got a death benefit that might say for the first 10 years, if you die in the first 10 years and you've lost money, well, we'll just bring you back up to whole. We'll give you your original premium back, your beneficiaries. Some of them might have a lifetime income rider built into them. There are annuities in the very basic theory of, they do have an annuitization option where you can turn on that lifetime stream of income, but you can always lose principal to the market. Okay, we don't like those. They also have very high fees. Not uncommon to see fees above 4% in a variable annuity. So we don't like those at all. Very rarely do we ever use one. Some very specific situations do we use a variable annuity. Most what we do is fixed indexed annuities, the FIA. So let's get into that. And we're going to compare the fixed indexed annuity to all the other different things that you can do with your money and talk about how they compare, right? With regard to risk and liquidity, because those are the two most important things, really. What's the risk, and can I get to my money? Because when I ask people questions, what do you want your money to do for you? They say, well, I want it to last. I don't want to lose it, and I want to have access to it when I need it. Okay. So what we do is we have this comparison of all the different financial vehicles, the most common ones anyway, and how they compare with regard to risk and liquidity. So if we just start over here with cash, you can see that your cash, well, your cash is principal protected. You know, if it's on deposit at a bank, I have clients that don't deposit money in the bank, but they'll put cash under their mattress or in their safe at home. Well, I don't really recommend that. Certainly not for very much, because it's not protected. You can lose it in a fire or theft. And try getting your home insurance company to replace that cash. You're just not going to do it. And you're losing out on opportunity just to make whatever little tiny bit of interest your bank's going to pay you in a savings account. But in a savings account on deposit at a bank, it's guaranteed by the FDIC, $250,000 per deposit or per institution. It's protected, right? It's not in the market, so you don't have any market risk. It's not going to provide a guaranteed income for life, and it's not giving you any kind of leveraged long-term care protection. So we talk a lot about long-term care, and some of the vehicles that we use provide some leveraged money for long-term care. So I don't want to get into it too much, but when we're planning for long-term care, we either need to have a batch of your money set aside, earmarked for that, or have a plan to use other people's money, meaning insurance companies, for long-term care. Well, cash in the bank doesn't really do that for you. So what are the pros of cash? It's always there when you need it. The cons are it doesn't really grow very much. Okay, money markets, CDs are the same way, except CDs can be limited because there are early withdrawal penalties involved with CDs. But you get at that guaranteed interest rate. You know what you're going to get when you start, and you're going to know what you're going to get every year or every term of the CD. Most CDs are pretty short term nowadays. People aren't really willing to take the interest rate risk with a 0.5% or 1%, or the highest ones I've seen recently, 2% CDs for 18 or 24 months. They're pretty short term vehicles. Nobody's really buying five-year CDs anymore. Okay, then we have the annuities that we talked about. So for the immediate, the fixed, and the indexed annuities, we do have principal protection. Remember, your initial premium is always insured by the insurance company and backed by the claims paying ability of that insurance company. That's why we're really looking for A-rated insurance companies. Those ratings are important. They do matter. When we're talking about fixed annuities or MIGAs, multi-year guarantee annuities, we can go down to maybe a B++ or B+ rated company. But anything else, we're looking for an A-rated, A-, A+, A++ company, because they've got the claims paying ability. They've got the cash on hand to match your dollar for dollar. When you need your money, it's going to be there. And they're not going to go insolvent. Very rare that an A-rated insurance company has a problem and goes insolvent. We're going to know about that ahead of time, because their ratings are going to start getting reduced, and it's going to be big news when a big insurance company like that goes out of business. But in all of these, your liquidity is limited. So annuities have what's called a surrender charge period, and during the period, which for multi-year guarantee might be 3 years or 5 years, or a fixed index annuity might usually 10 years is the most common. During that surrender charge period, your liquidity is limited. So when we're talking about a fixed indexed annuity, you're typically going to have access to 10% of your money every year without any kind of penalty or surrender charge. But if you need to take out more than 10% in any one year, well, you're going to pay a surrender charge on the amount above 10%, just as an example. And that amount starts out pretty high. It can be 9 or 10% in the first year. And then every year after that, it ticks down just a little bit, usually about 1% a year, so that at the end of the 10 years, there's no surrender charge. It's 100% liquid, and you can do what you want to with no penalties or charges whatsoever. But during that 10 years, you have to be careful. Lump sum distributions have to be well thought out. Surrender charge is a fee on your money that you don't have to pay. It's like an optional fee. If you take out less than 10% or less, you're not paying any fees at all. If you take out more than 10%, you're paying that surrender charge. Okay, so that's what we mean right here when we say access can be limited. You can always get your money. It's just you might have to pay a fee on it. All of them do provide income for life. They are annuities, after all, so they can be converted into that lifetime income stream, although we don't really annuitize annuities anymore, but I'll explain that in a little bit. Some of them can definitely provide leveraged long-term care benefits. So meaning you're not just spending your money dollar for dollar to pay for that nursing home or that assisted living facility. You're getting some money from the insurance company as well. It's not really the scope of this presentation today, but I deal with that all the time and can help you answer those questions. So the pros are they're going to give you that guaranteed income for life. They're usually going to have a higher rate of return on the fixed annuities than a bank CD. The regulators don't like us to compare them for good reasons. Your money in your bank is backed up by the federal government through the FDIC. Money with an annuity with an insurance company is really just backed up by the the claims paying ability of the insurance company. There's the financial strength of the insurance company, but interest wise, it works very similarly. Okay, it's guaranteed, contractually guaranteed, and you're going to get what you're going to get, and you know that ahead of time. Now, a fixed indexed annuity, we'll talk about this a little bit. You get to participate in the upside of the stock market without the downside risk. I'll explain that more. The cons are there can be surrender charges. If you need to cash out of this thing early, you're going to pay a penalty. And those penalties, at least in the beginning, the first few years, can be pretty high. So we want to be very careful and think this through. Variable annuities, nothing is protected. You have no market protection. Your money actually is invested in the market, which is probably where it's at now, except you're not paying 4% in fees. And you are limited. Right now, if you have your money in a managed money account or mutual funds or brokerage account, it's still participating in the stock market going up and down, but your fees are probably much, much lower, if any at all. But it's also 100% liquid, except for tax implications. You can take out all of your money whenever you want to. Well, in variable annuity, you still got the risk, you've got higher fees, and you have surrender charges, so your liquidity is limited as well. They do provide income for life if you want to. Most of them that I've seen do not have any kind of leverage for long-term care. The pros are you can make good money in them before the fees because you're in mutual funds. Most of these are mutual funds that are available on the open market. If you wanted to buy the same ones in your brokerage account, you could do that. But they do participate in the gains of the market. They do also participate in the downs of the market. So you have that risk as well. So we've talked about that and the fees on top of the surrender charge if you needed to take money out. Mutual funds, most of us have mutual funds, stocks and bonds, no principal protection, right? 2022 taught us that, we can lose money for sure in the stock market, in mutual funds, stocks and bonds. Your assets are not insured. Now, when we talk about bonds, some of your bonds are insured depending on the type of bond that you have. Some of them may be insured, especially if we're talking about municipal bonds, things like that. But for the most part, no, you can lose money because most people don't own bonds anymore. They own bond funds, right? No market protection. They are liquid. If you need to take money out of your brokerage account or your IRA brokerage, except for the taxes you may owe on them, they're completely liquid. There's no penalties or surrender charges there. They're nothing's guaranteed though. They do not provide income for life. We don't know what the market's going to do. Nobody can predict that. Even the people on Wall Street can't predict the market. If they did, it would always go up. We know exactly what was going to happen and everybody'd be rich, but that's not the case. They provide no leverage for long-term care. You're spending your market dollars, dollar for dollar to pay for a nursing home. Now, the pros are they do have a really high potential upside. If you're just, let's say you just own the S&P 500 fund, say a Vanguard S&P 500 index fund, it's got a huge upside potential, right? You could make 25, 30% a year in the really best years. But guess what? It's got a really large downside potential too. And we'll talk about why that's important here in a bit. And I'm going to do a couple of case studies for you and show you the downside. Okay. Commodities, these are risky. This is buying things like gold and silver and cattle futures and things like that. Alternative investments, this would be things like real estate investment trusts, limited partnerships, business development corporations. This right here, alternative investments, these are the things that start out well-intentioned that often turn into Ponzi schemes. I have clients right now that own alternative investments that are worth zero. They've got a nice piece of paper that says that they bought $50,000 or $100,000 worth of shares in this limited partnership, and now it's gone belly up and they lost literally all their money. So and they're usually illiquid, especially a lot of REITs, real estate investment trusts. They're not liquid. There's no secondary market for you to sell these things to other people. Some REITs are traded, most are not. You can't get out of them. And so If they stop paying dividends, which is usually the first red flag that something is really, really bad is going on, there's nothing you can do about it. You just have to ride it out and hope for the best. But the last few years, I've not seen the best happen. Okay, so what out of this whole chart, what we're really focused on right here is the fixed indexed annuity. So for the purpose of this presentation, this is what we're talking about. Now, I also deal in fixed annuities, especially multi-year guarantee annuities. I'll give you some of those rates here at the end and tell you what the rates are. I think you're going to be surprised how high the rates are. But fixed indexed annuities are the tool that really provide us the most bang for our buck when it comes to retirement planning. So that's the what is it? The next question is, how does it work? Right? So what it does is you put your money. Let's just use an example of $100,000. You've got $100,000 you want to invest, and you want that money to be safe and earn a reasonable rate of return. Well, that already right there fits the bill of a fixed indexed annuity. So you put your money in on deposit with an insurance company. That's called buying the annuity, and that money is called premium. Remember, it's an insurance product. So just like you pay a premium on your home insurance or on your health insurance, your Medicare supplement, that deposit that you give the insurance company is called a premium. And so I'm not going to call it a deposit anymore. I'm going to call it premium. And then that insurance company takes that premium that you've given them and they put that into their cash reserves and their bond portfolio. Very, very safe portfolio. Investment grade corporate bonds. And they're buying those bonds differently from the way you and I can buy bonds. They buy them $300 million at a time. And so they get higher quality and higher rates. And that's where your money always is. So we always say they have a dollar for dollar cash reserves. Well, in reality, it might not be a dollar. It might be, 89 cents, or it might be, $1.20. And that's where those ratings come from the ratings companies like Moody's and Standard & Poor's and AM Best. The higher their ratio of cash reserves and the quality of their bond portfolio gives them their rating, their A and A+ rating. Okay? So that's where your money goes. In reality, they put it into their bond portfolio, the majority of it, and they're earning interest on their bond portfolio. And again, we said they buy them differently than you and I do, so they're getting a really good rate of return. And let's say that they're making, just an example, these aren't real numbers, but just as an example, they're making 8%. They're making 8% on that bond portfolio. Well, they're going to take their share off the top. And let's say they take 5%. And that covers their operations costs and their marketing. It pays the agent that sold the annuity. It pays them their commission. And that's and then some profit too for the shareholders. Okay, so they take 5 out of the 8%. Well, that leaves 3% behind for you. That's your share. Now, with your share of that interest from the general fund bond portfolio of your investment with the insurance company, now you have different options on how you can take that. So this is where we get the fixed indexed annuity portion. Okay, fixed, you can take it as a fixed rate of interest. In other words, every year, every 12 months, 12-month period, they will declare what the fixed rate of interest will be. And you can take that. If it's a good rate of interest, you can take that and not take your chances on one of the indexed options. So say, for instance, the fixed rate option right now is 3%. You can take that, and just like a fixed annuity, you know exactly what you're going to get. You're going to get 3%, no more, no less. So on $100,000 premium in the next 12 months, at the end of 12 months, you're going to get $3,000, right? Very respectable rate of return. So you can do that, or you can take the indexed strategy option, or any combination thereof. So you can do 50% fixed, 50% indexed, or 25% fixed, or 75% indexed, or vice versa. But let's say you just, the fixed rate wasn't very attractive to you. We think the market's going to be doing pretty good. So we're going to take one of the index strategy options. Okay, here's how they do this. All right, let me go back. They take your 3%. Okay, so $3,000. Remember, they made 8 total. They kept 5 for themselves, and there's 3 for you. If you take the index strategy option, what they do with your share of that money, that $3,000, that 3%, is they go out to a market index. I always use the S&P 500 as an example because everybody knows what that is. You see it on TV every day, on the news. They report what the S&P 500 was up 5% today, or it was down 25%. Right? You see that. So I always use that as an example. It's very easy to understand. It's an index of the 500 largest companies in the U.S. stock market. And a composite of their prices gives us what the S&P 500 currently are around 4,000 or so. I haven't looked at it today, see if we're up or down. And they go to that index and they buy options on it. Now, an option, they buy an option contract. What an option contract says is, I'm going to pay you $1 today for the option to buy that index 1 year from now at a certain price. So let's say, for example, the S&P 500 today is at 4,000. Okay, that's fairly close to what it actually is. So I'm going to pay you $1 today. That's my purchase price for the option contract. You own the S&P 500. So I'm going to pay you $1 for the option 1 year from now to buy it for $4,000. Okay, all I've paid you is $1. So that's all I'm out right now. I still have my $2,999 over here. 1 year from now, I'm going to take a look at the S&P 500. And if it's up, let's say it's gone up to 5,000, from 4,000 to 5,000. Well, now I'm going to exercise my option that I paid you $1 for to buy the S&P 500 from you for $4,000, and I'm going to immediately go out on the market and sell it for $5,000. Okay, and make $1,000 profit. $999 profit because it cost me the $1 to buy the options contract. Okay, so that's if the market's up. I made $1,000. But if 12 months from now I go out and I look at the S&P 500 and it's down, it's gone down to 3,000. Well, guess what? I'm going to do nothing. I'm going to let that options contract expire, and all I'm out is $1, the $1 that I paid you for the option. Okay, so if there's where we get the description, the way I describe it, and every other agent in the world describes an indexed annuity. When the market goes up, you make money, and when the market goes down, you don't lose anything. And you don't make any money that year, but you don't lose anything either. Now, what happens is the insurance company eats the cost of the options contract. They don't charge that to you, but when the market's up, you make money, and when the market's down, you don't lose anything. Okay, and there's a bunch of different indices that we use. I always use the S&P 500 as an example, but I mean, there's 40 of them. The JP Morgan Mosaic, the Morgan Stanley Global Index, the S&P 500 Volatility Control. There's dozens of them. We try to keep it simple, not have too many that we have to keep track of, and keep the ones that just seem to be the best performers, which tend to be the simpler ones. Okay. Now, we say when the market's up, you make money, and when the market's down, you don't lose anything. That sounds like a pretty good deal. There must be a catch. Well, there are a couple of catches, and the catches are time. Remember, these are timed contracts, so usually on a fixed indexed annuity might be 10 years, typically 10 years. And so that's just the period where that surrender charge that we talked about applies. At the end of the 10 years, you can continue on with the annuity. It's just that at the end of the 10 years, the surrender charge has expired, and your money is 100% liquid with no withdrawal penalties. Okay. Another one of the catches is something called a cap. So in order to give you the protection from the upside, they can only afford to pay you so much. In order to give you protection from the downside, they can only pay you so much on the upside, right? And so they cap your interest every year or every period. And those caps come in different forms. One is a cap. So it's really just literally it's a limit on the top end of the interest that they'll pay you. So if the cap is, in this example, 5% on the S&P 500 annual point to point, that's 1 year. 1 year later, 12 months later, we look at it. If it's up, you make money. If it's down, you don't lose anything. If the cap on that is 5%, that's the most you can make on the upside. So if the S&P 500 is up 10%, what do you make? 5%. If the S&P 500 during that period is only up 3%, what do you make? You make 3%. But if the S&P 500 is down 15%, what do you make? 0. So the worst you can do is 0, but the best you can do is 5% if you have a 5% cap. Another form of a cap is called a spread. Now, a spread is on the bottom end. So that means that you have to overcome the spread before you make any money. So in this example, if the spread is 2%, well, the S&P 500 has to be up at least 2% before you start making money. Okay, so if the S&P 500 is up 5%, how much do you make? 3%, because they kept the first two. You get everything above that. If the S&P 500 is only up 1%, what do you get? You get 0 because you haven't overcome the spread yet. If the S&P 500 is down 5%, what do you get? 0. You don't lose any money. Okay. Another form, and one of the most common, is called a participation rate. This works a little bit differently from a cap or a spread, but same concept. What this says is that only a percentage of your money is participating in the index. I say participating in quotes because remember, your money's never really invested in this index. It's just that's what they're kind of placing their bets on, what we're placing our bets on. Okay. So let's say, for example, the participation rate on the S&P 500 is 50%. 50% of your money is participating in the index. Another way of putting it is you're just going to get half of whatever the S&P 500 makes. So the S&P 500 is up 10%. What do you get? Half of that, 5%. If the S&P 500 is up 3%, what do you get? Half of that, 1.5%. If the S&P 500 is down 10%, what do you get? 0. Remember, you never go backwards due to market loss. Okay. So that's the typical S&P 500 participation rate. Then we have some of the other hybrid indexes or fancy ones that we talked about. Sometimes they have some really attractive participation rates, greater than 100%. So you might see one that has a JP Morgan Mosaic 3-year strategy with a 200% participation rate. So if that strategy over a 3-year span is up 10%, what do you get? 20%. You get 200% of whatever the index is. Okay. Now, those look attractive. Some of them are 300%, but a lot of them, they're only making 3 or 4% a year anyway. Okay. So what's 300% of 3%, right? It's 9%. So it's not, they will present these big, seemingly outrageous participation rates, but we kind of have to put it into perspective. And remember, it's not like the S&P 500 where you might make 25%. It might be up 25%. Well, you're not getting 200% of that, right? So that you don't see those big participation rates on the S&P. You see it on some of these other hybrid indexes. All right, we're just trucking right along. I'm going to check here to see if we have any questions. Don't really see any. All right. So that's how rates and caps work. And this is kind of what it looks like on a chart. So this is a chart of the red line is the S&P 500. If we go back to the year 2000 and we say that, for example, we put in a brokerage account $100,000 and we just bought the S&P. We were able to mirror the S&P 500. And so whatever the S&P 500 is doing, whatever you see on television or hear on the radio in the morning, that's what you made. Well, if you started in 2000, well, guess what? Your first 3 years weren't very good, right? So what happened in 2000, 99, 2000, we had the dot-com bubble. I know a lot of you remember that. And then what happened in 2001, 9/11, that wasn't good for the markets. Wasn't good for anybody, but especially the stock market. And you know, we didn't come out of that till really like 2003. You know, what did they do? They lowered interest rates. And finally, once we started to recover from, you know, the mayhem of .com and the tragedy of 9/11, you know, it was a good 3 years before we started coming out of that. The Federal Reserve and the Treasury, through, you know, their things that they do with fiscal and monetary policy, we start coming out of it. Year 2004, you know, we're making money up till 2006, 2007. What happened in 2007? That began the financial crisis. And we always talk about 2008 because that's just the longest period, the heaviest hit. But really that financial crisis and that recession, the Great Recession, lasted from the fall of 2007 till the spring of 2009. It was about a 18-month period. And so we were down. But if you just look, I want to go back one step. You put in $100,000 and lost money for the first 3 years, down to $60,000. So that's probably not making you feel very good. And you got back up in the next 1, 2, 3, 4, 5 years. You just almost got back to where you started. And then the financial crisis hit, 2008. Now you're back down to $60,000. Right? And then back up, coming out of the financial crisis, the Great Recession. It takes us all the way to 2013, 14 is really when I saw some of my clients had started to break even again. So what do we call that? We call that like the lost more than a decade. So from 2000 to 2013, your money was just flat. That's assuming you weren't taking anything out, right? You weren't taking distributions. You weren't taking required minimum distributions. You weren't paying any fees, right? You just had your shares there and you were just riding the market. 2013, you still had $100,000, right? And then we can see what the market did from there. But the green line is what I do with a fixed indexed annuity. And this is assuming a 50% participation rate in the S&P 500. So remember, when the S&P 500 goes up, I get half of what it makes. But when it goes down, I don't participate in that downside. I get a zero that year. So you can see for those first 3 years, well, I didn't make anything, but I still have my $100,000 premium. That's still intact. It has not gone down. And then when the market finally did start coming back up, well, I made some money, right? The market's going up, it's going up, it's going up, it's going up. But then it came back down. Financial crisis, your S&P 500 index fund is down to $61,000. But where's my client's fixed indexed annuity? It's at 130. Did not lose any money, did not lose a penny in that account, in that contract during the financial crisis. And then when we finally started coming out, started going back up, and then we had, you know, a couple of rough years. 2015, 20 was kind of a rough year. 2013, there were some, but for the most part, we're going back up. You can see here, 2018, we had the worst Christmas Eve in the stock market in a decade, wiped out the whole year's gains in about 3 days and ended the year as in a negative in 2018 going to 2019. Well, guess what? You didn't lose any money in that flash crash. Now, the next 3 years have been pretty good. We had COVID was here, right? So that COVID crash came way down, but then it came way back up. And by the end of the year, 2021, 2020, 2021 were good years. And so you can see the market's coming back up, but your annuities come, and eventually, because it was really, especially 2021 was a really great year, it caught it. But guess what? They haven't put this chart out yet. Where's the 2022, where's the red line? It's down here somewhere. S&P 500 was down about 17%. I'll show you those numbers in a minute. In 2022, not a great year, but where is that green line is holding right there at 326,000. Okay. As soon as they put out that new chart, then I can send that to anybody that wants it. So you can see in a chart how it works. You have the red line, you have the green line. Now I do both, and I think it's important to have a balance of both. But I think it's very important to have some of the green line as well. So that's how it works. Here's why you might need one. So we're going to do a couple of little case studies here. And I'm just going to cite a couple of things. I'm not going to really talk about this too much, but a lot of smart people in investing, way smarter than me, are starting to see the benefits of fixed index annuities. One of them is a company called BlackRock. You may have heard them. They're the number one biggest asset manager in the world. They just came out with a white paper, I think it was last year, that says you need annuities. You need not annuities, fixed index annuities specifically in your retirement account. And even really on the accumulation side, when you're still working and making money, you still need to have these things are really important in your retirement plan. So this is an 18-page white paper from BlackRock, the biggest money manager in the world, with mutual funds and exchange traded funds, not annuities. But they're saying annuities are an important part of the puzzle. All right, so if we compare to just your typical 60-40 asset allocation style portfolio, which is where a lot of people come to me from. And it's where they're at, what they're doing when they come to me. Okay, so if we compare to the way most people come to me invested, they're in their 60-40 portfolio, which is, what you'll learn when you're working and you're getting closer to retirement. You're kind of turning down the risk and going 60-40. And what that means is 60% equities, which means stocks, companies, and 40% income, which typically means bonds or bond funds. And what that does is it's supposed to reduce the risk, right? You take 40% out of stocks, which is more volatile and doesn't provide any kind of income. You put that 40% into bonds, which provides a little bit of income and reduces the volatility in the portfolio. Okay, so I ran some numbers and just start out with the case study here and explain what these numbers mean. We've got a client that had $1.18 million in their 60-40 asset allocation style portfolio. And they're 73 years old, and they came to me in 2022. But what I did was I projected how this portfolio would have performed based on the last 25 years of returns. Okay, so we backcasted this portfolio for the last 25 years, which would have started us in 1998. So if he had started with this retirement plan in 1998, he was age 73. He's 73 now. And they need to take, between the two of them, him and his wife, they're drawing $60,000 a year is what they need out of this plan. And this sounds like a lot of money, and it is. But they have a very comfortable lifestyle, and in order to maintain that lifestyle, that's what they need. Okay, and so that first year, well, they made in that 60-40 portfolio 14%, but they withdrew $60,000, and they paid a 2% fee. So management fees, mutual fund fees, third-party money manager fees, they all add up to, if you have a financial advisor, a fee-based financial advisor, when you're talking about the all-in fees, about 2%. Now, we'll talk about fees for just a minute. A lot of financial advisors will tell you, yes, I charge 1%. Now, as a financial advisor, I will say that it's okay to pay a management fee. As a financial advisor, I think it's very important that I get paid for what I do. I don't work for free, and I'm in business to make money and earn a living for my family, and I get paid to do this. But if a financial advisor says I get paid 1%, well, that's what they get paid. That's what I get paid. That's my cut. But there's more fees involved. There's mutual fund fees, expense ratios, right? Which on the typical mutual fund is, well, depending on the type of fund, there may be a front end load or a 12B1 fee or just a expense ratio or a combination of all the above. But Forbes tells us it's about 1.53%, but let's just say it's 1%, right? Well, 1.5%. No, I'm sorry, take it back. Say it's 0.75. Okay, so your expense ratio on your mutual fund is about 0.75. So your advisor's getting 1. The mutual fund for their operating expense, their internal fees, is getting 0.75. And then there's other people involved. There's third-party money managers, there's custodians. That all adds up to about 0.25%. Right? So all in, typically you're looking at about 2%. Now that may not all be disclosed in black and white to you. It is disclosed, but it's in the prospectus. You have to go searching for it. But the advisor tells you, yeah, I make 1%. Okay, well, that's great. And that's okay. 1% is a reasonable advisory fee, but what's the all-in cost? So I'm using the typical all-in cost of about 2%. Okay, long little way of saying you're paying for that. You made 13.93%, 14%. You paid a 2% advisory fee. So that gives you your net return of 13%. So you went from 1.18 million after your $60,000 withdrawal. You're now at 1.26 million. Okay. So you see how that works? And then now we can't just take 60,000 out a year forever. That's got to go up because cost of living goes up. There's this thing called inflation. Right now we're in very high inflation period, right? The new numbers came out this week, showed inflation was still at 6.4%, 6 point something, down a little bit from last summer where it kind of peaked out in August at, almost 9%, the highest inflation rate in 40 years. What I've done here is I've added 4%, rate of inflation. It's higher than what we are told is the historical rate of inflation of 3%, but it's lower than these, really high rates we're in right now. So if we can come to a medium, I say, 4%. And so every year you're going to see this withdrawal go up by about 4%. And then the next year, 99, this portfolio did okay. You netted about 9.27%. But then we had, the dot-com bubble. So now we're just barely making some money, between your 60%, starting to crash in the dot-com bubble, your 40% bond portfolio, your net after fees, you've lost 1%. Then we're fully into .com and 9/11. You're losing 6%. All right, then we have a few good years, but you see the point here. Every year you're taking out a little bit more money. You're paying fees. You're winning. You're losing. That money should last you about 20 years. Okay. In a 60-40 portfolio, you have an average annual return of 6.44%. Before you ran out of money, you took withdrawals, cumulative withdrawals of almost $2 million, 1.85. So you started out with 1.18. You took out 1.85. So you got some good return, over those years. But I mean, what if you outlived that money? Now you're out. You're out of money. All right. What if there was other things that came up? You needed a new roof on the house. You had some medical emergency. You had long-term care. You're going to spend a lot more money. Okay, but your net returns after fees is only really about 4.4. So that's just barely keeping up with the 4% rule, which we know is really not the 4% rule anymore because of inflation. So that's what your typical 60-40 portfolio would look like. And this is a real client. This is a case study on them. Okay. But what if we took that same 60-40 portfolio and now we blended it with a fixed indexed annuity and took just about 50-50? It doesn't quite work out because of a bonus, which I'll explain. And we took about 600,000 out of that 1.18, and we put that into a fixed indexed annuity. And in this case, it's with a company called Security Benefit, and they have a big bonus right now, a cash bonus, 13% bonus. And so you start out with, I don't know if you can see this, but 678,000, because that includes your 13% bonus. And when we look at the back-tested returns on this, it averages out to about 8.01% per year. So we add in that 8.01%. There are no fees. So there's no fees to pay. So your net return is what you get, right? Now remember, some years you're going to get 0. Some years you're going to get much bigger numbers than this, but average is going to be about 8% in this particular product. Now there's many different products. They do different things. They have different returns, but this is one that I'm using for this illustration. Okay. We're still taking out our $60,000 a year, increasing it 4% every year for inflation. And you can see here, there are no negative years, right? There may be some zeros, but there's no negatives. So that means something. And so that money, that 600,000, that's still going to last you about 16 years. But let's hope you're going to live more than 16 years, right? So at 16 years, that account's going to go to 0. But guess what? We've still got that 580,000 that we left in the 60-40 model, paying the fee. We're not touching that money until this one runs dry. Okay. So even with all the win years and the loss years, you're still doing pretty good. So when it's time, when this one runs out, we're sitting pretty over here. We've got plenty of money left. So we can start taking our withdrawals out of this side. And guess what? Now we've taken out 1.2 million over here. First, we took out 1.3 million over here. So if we look at how does this work? Oh, there's a typo right there, misspelled word. We took out a total of $2.5 million. That's what we took out. At age 97, 25 years later, we still have 191,000 left right over here. You can see that hopefully, which makes the lifetime value of this portfolio to age 97 of $2.7 million. We started out with 1.18. The lifetime value after we took out $2.5 million is $2.7 million. So that's just taking half of what you had in the 60-40 model and putting it into a fixed indexed annuity. Taking out the negative years, adding a 0 in their place. Now, for purposes of my spreadsheet here, I average those returns out. Okay? But that's what it does. Okay, so that looks a little bit better than the previous slide where we're having ups and downs. We don't know, you know, if you lose 25%, it takes, how much do you have to make to get back to where you started from? Probably around 45%, right? So it takes a lot more to get back, make up those losses. And you're running out of money at year 21, you have no money left. Whereas if we just take half of that money, leave the other half where it's at. Don't touch it. That's an okay plan. Leave half of it where it's at and put the other half into a fixed index annuity. Now we're at the end of 25 years, we still have quite a bit of money left. But wait. So we've taken 50% of our 60-40 portfolio and putting it basically into the 40% side. So it's really not a 60-40 portfolio anymore. It's much differently weighted allocation. But what if we took 50% and we put it into the annuity, but we took the other 50%, instead of keeping it in that 60-40 portfolio that's a little bit less aggressive and less volatile, and we put that all into stocks in a 100-0 allocation. So basically now what you have is a 50-50 portfolio, 50% stocks, 50% income. But this time with a bond alternative, because we know, you may know if you have them, is bonds have kind of stunk it up for the last 10 years, maybe more than that. And what happens to the price of your bonds when interest rates go up? The price of your bonds, and really bond funds, goes down, right? So you're not really living off the dividends of those bonds. You're living off the sell price of those bond funds. When you need money, you sell shares of the bond funds at the lower price. When interest rates rise, as they are, the price of your bond funds drops, okay? So we have a bond alternative called a fixed indexed annuity. So we can keep our aggressive part, we can keep the equity part. Well, in this case, we're going to make it 50-50, right? And we're going to invest it in my portfolio where it's an all-in fee of 1.5%. So that's my share plus the expense ratios of the exchange traded funds, usually BlackRock or Vanguard. Very simple index funds, nothing fancy, nothing actively managed where the cost to you is very high. So we're taking that from 2% down to 1.5 all in, and we're making that all aggressive. But that's only on about half of the money. The other half, we're putting in that fixed index annuity. So this chart's exactly the same. We're still running out of money at about year 16. So in year 16, we're going to have to start drawing out of this portfolio. But now, because it's all in equities, now we've raised that average rate of return. We've reduced the fees, which raises the net average rate of return. So now we've taken the same 1.3 million out of this side, the same 1.2 million out of this side, 2.5 million total withdrawals, but now we still have $500,000 left at age 97. So now the total lifetime value of that portfolio to age 97 is $3 million versus this one, 2.7. We've added quite a bit of money to that versus your 60-40 portfolio where you're empty and you've only taken out 1.8. Okay. Now, the reason I say blend it, do both, is because you cannot put all of your money into an annuity. Okay. And the reason for that is because it's, at least for the term of the annuity, 5 years, 10 years, your liquidity is limited, right? So you're going to be limited essentially to 10% per year without paying penalties. And we need you to have some liquid money, right? And we need you to have liquid money that you can get to without paying any kind of penalties for various things. Your liquidity, you have an emergency, you want to go on a trip. You need to access to that money easily and free, okay? That's why you can't put all of your money into an annuity. The law doesn't allow it. My philosophy doesn't allow it. I know agents that will do it. You got $200 in your checking account, we'll put your whole $100,000 IRA into an annuity. That's not the way it works. That's what gives agents and annuities a bad name. Don't let anybody do that to you. But if you take a blended approach, this is what we come up with. And I think it works out better for everybody. Okay. We have a question that says, how do FIAs net 8.1% consistently for 16 years with no fees? Well, it's just because of the way that they invest the money. So remember, your money is invested, your actual money, the money that you give them, is invested in their bond portfolio. And then they're taking a portion of the interest that they earn on the bond portfolio, and they're buying options on an index. In our example here, we use the S&P 500. Okay, so when the S&P 500 goes up, you make money, and when the S&P 500 goes down, you don't lose anything. So I'm really going to explain this probably a little bit better in the next couple of slides. If we can take out the negative years and replace those with a 0, imagine not losing 37% in 2008. But instead of losing 37%, you didn't make any money, you just got a 0. Okay. Even, and I'll show you how this works in a second, even if we can, in the up years, we can only get half of what the S&P 500 did. Okay, so that's pretty interesting. But let's talk about those fees for a second, because we've got a question about that too. We just to bring that point home a little bit more, the typical fees that I see people paying when we look into it and get above just the financial advisor's fees is about 2%. I've seen some higher, some a little bit lower. Typical is about 2%. So if we're paying 2% on the whole portfolio, which you likely are, then that 1.18 million is costing you $23,600. Okay, that's 1 year. Now, as you make money, well, that fee is going to go up, right? You lose money, do you keep paying that fee? You betcha. Your advisor loses money for you, you're still going to pay that fee. Right? But what if we're just paying that fee on the managed portfolio portion only and not on the bond alternative, right? But in here, I kept out some cash as well. No fees on that. That's just going to go in your savings account just for some added liquidity. So that brings our fees on the total portfolio down to 0.9%. So less than 1% when we look at the big picture. Now, I think that probably answers your question about you really cut your fees for securities from 2% to 1.5% with smaller investment accounts. It's right. When you apply the amount of money that you're paying in fees to the total portfolio, that percentage is much lower. So let's say we had this swap, like a lot of my clients are much more conservative than even what I've shown you. They're more like a 40-60. So if we're doing 60% in the bond alternative, which is the fixed index annuity with 0 fees, and 40% keep it in managed funds at 1.5% in fees, well, that brings your fee on your total portfolio down to more like 0.62, really, really low, relative to what most people are paying now. So that cuts your fees less than half, right? So you're only paying $10,000, and that's going to me. I'm getting 1.5%, 1%. The 0.5 goes for the expense ratios of the funds and the custodians and third-party money managers and everybody else that needs to get their cut. But I've reduced the middlemen greatly, and we do a lot of things a lot more passively on the managed money side these days, where I've cut out a lot of the third-party money managers and done a lot more index fund investing. It really brings those fees down because there's really 2 major headwinds to your retirement. That's risk and fees. All right. So if we can cut out the risk and greatly reduce the fees, we might not be able to eliminate the fees completely, but that's okay. If we can cut them in half or better, that's just that much more money that stays in your pocket. All right. Let's see. We'll move along. I see one question. I might save that for a little bit later. And again, I'm missing some pages. All right. While I'm doing that, I'm going to go ahead and answer this question. Calculating a fixed annuity, they start at the value of the index group that you picked at the time of the contract. So a year later, they compare the value of the group. And every year they're calculating the up and down using original opening value, or they use last year's ending value. That's a very good question. And there's the answer is they have the new value. So it's a reset, annual, they call it an annual reset. So whatever your balance is, first of all, whatever your new balance is, because they credited you interest, that's your new floor. So that's your new principal amount. So you can never go below that. And then they they take a new snapshot from that index at that date. So that's your starting value for the upcoming year. Okay, so you don't have to go back all the way to day one. You go back to that year. Okay, so it's a stair step, and it's kind of I sometimes equate it to a ratchet. You know, a ratchet, a wrench, you go forward, but you can't go backwards, right? And so that's how you tighten it. But it clicks back, right? And then when you pull it back up, so it can never really go backwards. And so another question, CDs are getting hyped again. Does it make sense to park some money for 15 months or so? I would say yes. However, I wouldn't, depending on the amount of money you're talking about, I wouldn't put it in a CD. I'd put it in an I-Series Treasury bond. So I-Series Treasury bonds are currently paying 6.89%. And it's a 30-year bond, but you can cash it after 12 months with no penalties. And so it's a variable rate. It changes every 6 months. So you've got at least 6 months. It changed in October. It went up a little bit. And now the only catch is you can only do $10,000 per year per person. So for smaller amounts of money, that's what I'm advising for my clients, to keep CD type money in or a short-term multi-year guarantee annuity. But those I-Series bonds are really good too. I don't sell those. I don't make any money, but they're real easy to buy on treasury.gov. And clients come into my office and we set up their account. We buy them right there, and I help them buy them. Here we go. All right. So this chart here kind of illustrates, and I hope you can see this. Yes, you can. Illustrates a concept that we call sequence of returns. And the sequence of your returns matters, especially when you're taking money out. Especially when you're taking money out. So if we use, this is a different case study here. This is George and Jane. They're husband and wife, and they each have $500,000 to invest. And George retired in 1998, and he put all of his $500,000 retirement fund straight into the S&P 500. We always use that for an example because it's just easy. He retired in 1998, and he's withdrawn $30,000 a year out of his account. Okay, and so he goes along and he has the ups and downs of the S&P 500, but in year 2018, 20 years later, he's still got $100,000 left, as you can see here. All right. Well, Jane, his wife, she worked an extra 2 years. Okay, because she was younger, she felt better. He went fishing for a couple of years. She kept working. Okay, but she waited 2 years. So in 99, 99 or a year. Yeah, 2 years at issue. So he started in 97. She started in 99. Same $500,000. Same $500,000. Same market, S&P 500. Same withdrawals, $30,000 a year. But look, so they both got the same returns, right? Minus 10, minus 13, minus 23, plus 26, plus 9. They both got the same returns, but timing is everything. Okay? And I don't mean, let me explain what I mean. Timing is everything. Sequence of returns, not the returns themselves don't matter so much. Because she started 2 years later, she took the brunt of those first 3 years right up front, which set her so far back that she ran out of money in 2013. She ran out of money 1, 2, 3, 4, 5 years later, really earlier than that, because he's only taken out $30,000 a year. So if he doesn't make or lose any more money, he's still got 3 years to go, right? Invested the same. Timing is everything. So that's called sequence of returns. And that's why if we can show you that we can just take out the zeros and replace them even with 50% of what the market would have done, your money will last longer. And that's so important when you're taking money out. Not as important when you're not taking money out, although if we can take out the negatives and add a zero, and that's still better, but it's even that much more important when you're taking money out. All right, saw a question about rider fees. I didn't talk about this. I probably should have. Most annuities do have riders available. They're optional riders. They might be a lifetime income rider. There might be an enhanced death benefit rider, might be a long-term care benefit rider. Sorry, I'm trying to get back to where I can see the presentation here. There we go. Those riders come with fees. Now, the concept that I've shown you here does not use a rider. Okay, so that's where we get no fees. These are just simply systematic withdrawals from the annuity contract. It's not annuitization, and it's not activating an income rider. So income riders have fees, generally about 1%. And they act like annuitization, meaning turn that money into a lifetime stream of income with all the same types of options as an annuity: lifetime, joint lifetime, period certain. But they have a fee, right? And like an immediate annuity, remember I said the insurance companies, the actuaries, they know about how long they have before you start getting their money. And those income riders are going to take about 18 years just to pay you your money back. So that means that you've paid that 1% fee for 18 years that you were getting your money back, but all the front end years of deferral before you started drawing the income. So you've paid 1% on your money for 20, 25, 30 years, really just for the privilege of getting your own money back. When I can give you the same results without paying that fee. Now, if you use a rider, well, this income here is guaranteed not to run out, though it's not going to be that much. It's generally going to be about 5%, 6%, depending on the age that you were when you activated the rider. Okay, so you're not going to get that much, but it's going to be contractually guaranteed to last for the rest of your life. And then whatever's left at the end when you die passes on to your beneficiaries. Okay, but the insurance companies know about how long they have to get your money back to you before you start getting into their pocket, and they've calculated it that way. So I'm all about beating the insurance companies. I work for you. My job for you is to beat the insurance company at their own game. And this is one of the ways I do that. So we get your money back without paying the fee, which is probably what you're going to do with the rider anyway, is just pay that fee for the privilege of getting your own money back. Okay. So, all right, I've gone a little bit longer than I wanted to. So we want to recap. What is it? It's a fixed indexed annuity. How does it work? You put your money in an annuity contract with an annuity company, an insurance company, and they pay you money when the market's up. And when the market's down, you don't lose anything. And you make your money last the rest of your life. Why do you need it? Because you need your money to last the rest of your life. And working with a good, licensed and trained and experienced local broker and advisor like myself, we can put together a comprehensive retirement plan that takes into account lots of things, not just your rate of return, but your health, your long-term care requirements, your future plans, like your travel, your grandkids. All of these, puts it all together, and we're really just plan to have a retirement plan that you can't outlive. And if somebody starts shooting missiles overseas, you don't have to change your plans. All right. If you get a hurricane in the Gulf that disrupts oil supply, which has a ripple effect throughout the market, you don't have to come home from your vacation in Colorado early because you have to tighten your belt. So that's really what I do, is I protect your retirement plan from things that you can't control. Okay, I put that safety harness on. All right, so I told you I'd tell you about the best deals currently, and here's what they are. Our 3-year MIGA rates. That means that fixed interest for 3 years, no more, no less. Currently, this is as of February 3rd, 2023. These rates change all the time, but that's what they are right now, from a company called Atlantic Coast Life. Guaranteed yield to surrender is 5.53%. That's per year, annually, for 3 years. A 5-year MIGA, really not that much more, so I really don't recommend going 5 years versus 3 if all you're going to get's 13 to 12 basis points, 5.65%. A short-term fixed indexed annuity, 5 years, no bonus, currently has a 4.1% cap on the S&P 500 and a 2.1% fixed interest rate. So we can blend those two. We can take one or the other. That's the best 5-year fixed indexed annuity going. And then our kind of the one that we're really looking at heavily now is the one I used in our case studies, is from Security Benefit Life. It's a 10-year fixed indexed annuity. And it currently has a 13% cash bonus. So if you put in $100,000, they're immediately putting $13,000 on top of that. You start earning interest on the $13,000 immediately. It's got a 3% fixed rate. So for that first year, what I've been doing lately is just putting everything in the 100% fixed, not even worrying about those indexes that we talk so much. So do the math on that. That's a first year, 12-month net yield of about 16.39%. Folks, the S&P 500 was only down 16% last year. So on that amount, that portion of your money that we're putting into this, we're making back all your losses from 2022, year one, guaranteed. And then at the end of the first year, we go back and look, we have the option to change options from the fixed to the index. If we think the market's coming back up, we can go into the indexes. If we don't think the market's coming back up and the fixed rate's still looking attractive, we just stay there. So that's my job, is to work with you every year on that. Yeah, so good question. Is the bonus vested? Yes, it is. The bonus is vested. You can't cash this thing out in year one and keep the whole bonus. They're gonna recapture a portion of that. It's vested in over the 10 years, so about 10% a year. Yep. But you're earning interest on the full thing from day one. Very good question. What about the I bonds as a hedge against inflation? I think they're a very good hedge against inflation. It's just that they're limited. So you can only buy $10,000 worth of them a year per person. So that's where we may still also look at things like CDs. If we can find attractive CD rates, but I really don't think you can, especially when you compare them to a 3-year MIGA at 5.53%. Look out in our area, Security Service Federal Credit Union's probably got the best CD rates. I think they're right at 2% last time I checked. So folks, I'm hurrying because my software is telling me I only have a few minutes left before it cuts me off. I thought I paid for the big package, but I guess I didn't. So my offer to you is, you come in, if any of this interests you, come in, let's get together. We can do it virtually over Zoom if you like. And let me run these numbers for you. Let me put together a case study based on your actual numbers. We'll look at your portfolio, do an analysis of it, and see what your fees and your risks are, and then put together a plan that looks like this, and see what it looks like. See if it makes sense to you. And if you do that, I'm going to give you a couple of gifts. One, I'm going to give you a book. So this book's from Patrick Kelly, and this is a very easy read. It's not very long, but it explains the concept of the fixed indexed annuity in very simple terms that all of my clients have been able to understand. Is really, really good book. And every chapter deals with one of the problems that we've addressed today. And also, I'm going to buy you steak dinner. I'm tired of doing seminars and buying people dinner, expensive steak dinners, and they never come in to see me. So, but I still want to buy you dinner. If you do this, I'm going to give you the book, and I'm going to give you a $100 gift card to, well, I could probably do it to the restaurant of your choice, but I like steak dinner. So let's do a steak dinner. We've got a couple of agents on here that I've trained over the years. I like keeping up with them and helping them keep abreast of what's going on in the industry and help their clients as well. Agents, I'm not buying your dinner though. Sorry. So that's about all I have. I've got about 5 minutes left before we get cut off here. So I don't see any new questions, but you've got my contact information. Number is 830-217-6711. Of course, it's Friday, so we're all I'm here in the office working, but Betty and Erica and Kristen, they've all taken off for the weekend and left me here to work, but I don't mind that. It gives me a chance to catch up with you folks on a webinar like this. 830-217-6711. Give us a call on Monday. We'll get this set up. Also, I've got a little something here for you. I forgot to put it up. You can click on this link right here, take you directly to my calendar, and you can schedule that appointment. Now I've got space, I've got the capacity in my schedule to do one of these plans for about 10 new clients in the next 30 days or so. So if you should be able to see that button right there that says schedule your appointment. Really, the consultation really only takes about 60 minutes or so, about an hour or less, and then we can get that to you. So click on that button and take you right to my calendar. You can schedule that appointment at your convenience. Also, check us out on the web at www.t65s.com. That's our main website, and hope to see you soon. And if you have any questions about this, give me a call or an email, ron@t65s.com. Have a great weekend, folks. I got to go home and cut up wood from the ice storm. Anybody local? Hey, free firewood at my house this weekend. Bring your own chainsaw. See you later, folks. Have a great weekend.